You know how it is with standard trading indicators. Sometimes they feel like a pretty blunt instrument, right? We're all looking for that real edge, a way to see what everybody else is missing. Well, today we're going to take one of the most common indicators out there, the RSI, and turn it from a simple gauge into an absolute precision tool. And we're going to do it by diving into the incredible work of Walter J. Baeyens.
So let's just get right to it, because I know you've been here. How many times have you seen the RSI creep above 70? You think, okay, overbought. You hit sell, and the price just keeps screaming higher. Or it drops to 30, you buy that oversold dip, and whoosh, it falls right through the floor. It's got to be one of the biggest frustrations in trading, hands down.
Well, here's the big idea, the major breakthrough from Baeyens' work. The problem isn't the RSI itself. The problem is how we've all been taught to use it. We're so focused on those overbought or oversold levels. But the real, juicy, predictive information, it's not in the number. It's hidden in the shape, the structure, the patterns of the RSI line itself. Okay, so let's start building out this new way of thinking. We're basically going to rewire your brain on how you see the RSI and what it's really trying to tell you about the market's momentum.
You know, Baeyens himself points out something that's so critical. Even when the price is in a clear, obvious uptrend, the RSI doesn't just climb right alongside it. It zigs and zags, it ebbs and flows. And that little disconnect, that's our first clue. It's telling us that price and momentum are two different stories, even though they're related. And we need to learn how to read both of them.
So here's the mental shift I want you to make. Stop thinking about the RSI like a car speedometer, just telling you if the market's going too fast or too slow. That's the old way. Instead, I want you to start seeing it as a detailed topographical map. It shows you the hills, the valleys, the channels, the entire terrain of market momentum. And once you can read the map, you can start predicting the path ahead.
So, how do we start reading this new map? Well, the very first step is to learn how to draw its main features. And we do that by identifying what Baeyens calls RSI channels.
So, take a look. At first glance, a regular RSI chart just kind of looks like a bunch of random squiggles, right? A series of peaks and valleys. But here's the thing. Just like price action, momentum isn't random at all. It moves in very distinct phases, with its own levels of support and resistance. Our job is just to make that hidden structure visible.
Now watch this. Look what happens when we do something incredibly simple. We just connect the significant lows, like points A, B, and D right here. All of a sudden, bam, a clear descending channel just pops into view. Now remember, this isn't a price channel, this is a momentum channel, and it defines the boundaries and the trend of the market's underlying strength. It's a whole new ballgame.
So what this RSI channel gives us is this incredibly powerful visual framework. It kind of puts the indicator's movement in a box, showing us the prevailing direction of momentum. When it touches the bottom line, that can be support. When it touches the top, that can be resistance. And if it breaks out of that channel, that's a huge signal that a major shift is underway.
Okay, so now that we can actually see the map, it's time to learn how to read the signals that appear on it. And trust me, this is where the strategy really starts to get exciting.
Baeyens focuses on these two really powerful types of divergence. He calls them dynamic divergence, or just DD for short. So the bullish signal, or DD+, happens when the price makes a new low, but, and this is the key, the RSI makes a higher low. That's a secret message telling you that the selling pressure is running out of gas. Now the bearish DD- is the exact opposite. Price hits a brand new high, but the RSI makes a lower high. That shows the rally is getting weak. And look at this key rule at the bottom. These signals are the most reliable when they happen inside the channels we just learned how to draw.
Let's just break this diagram down really quick. Over on the left, you see the bullish DD+. See how the price at point B is lower than price at W? But look down at the RSI. B is actually higher than W. That's the divergence, that's the signal. Now on the right, for the bearish one, the price at Y is higher than X, but on the RSI, Y is lower than X. It's this visual mismatch between price and momentum that gives us our high probability setup.
Okay, so we've got our channels and we've got our signals. Now we need the third and, maybe the most important element that ties this whole thing together, using multiple time frames to confirm everything.
This right here, this is what separates the pros from the amateurs. It's a simple three-step filter. So step 1, you find a potential signal on your main chart, let's say the hourly. Step 2, you zoom out to a higher time frame, like the daily chart, and you ask one simple question. Is my signal going with the flow of the big trend? If the answer is yes,
you've got a great setup. And finally, step 3, you can zoom in to a lower time frame to really nail your entry point.
All right, theory is great, but let's put it all into practice. We're going to take a real chart example from Baeyens' work, and we're going to apply this entire 3-part strategy, step by step, so you can see exactly how it works.
Okay, so here's our hourly chart. Now, the very first thing we do, before we even think about looking for signals, is we map the terrain. We draw our channels on the RSI, connecting those important peaks and troughs. Just like that, we've defined the current structure of momentum. We now know the boundaries we're playing in.
And this is where it gets really interesting. We have a conflict, a bit of a showdown. There's a bearish DD- signal showing up near the top of that RSI channel. But at the same time, a bullish DD+ signal is starting to form right at the bottom. So which one do we listen to? The hourly chart is sending us mixed signals.
And this is exactly why we need our time frame analysis. To solve this puzzle, to figure out which signal to trust, we just follow the process. We zoom out to the daily chart. We need that bigger picture view to see who's really in control here, the bulls or the bears. And there it is. The daily chart gives us our answer loud and clear. That major bullish support line, the one connecting A to C, it's holding firm. It's still being respected. What does that tell us? It tells us the primary trend is still up. And that means the bullish signal on our hourly chart is the one that's aligned with the dominant market force. That makes it the high probability trade to take. The bearish signal, that was probably just a little pullback, some noise along the way.
So let's just boil this all down. Your new game plan for the RSI is just 3 simple steps. 1. See the structure. Draw those channels on your RSI to map out the trend of momentum. 2. Decode the signals. Look for those high-probability bullish and bearish divergences inside your channels. And 3. Always confirm with context. Check those higher and lower time frames. Structure, signal, and confirmation. That's the whole strategy right there. By just shifting your thinking from a simple speedometer to a detailed map, you've really unlocked a whole new way to analyze the market. The RSI isn't just a number anymore, it's a landscape, and it's filled with clues. So the only question left is, what new patterns are you going to find on your charts?